Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, everyone. So today we will present our discussion about analyzed company. But before we get into the transaction of analyzed company, I would like to introduce myself and my group members. My name is Moza Aurora, and my group members are Ghuran, Muhajjalin, and Amila Sholehah. So we have the transaction and the account balances of an analyzed company. Before the transaction, we need to look out for the account balances on analyzed company. On debit side, we have cash for $4,800, account receivable for $3,900, inventory for $1,008, equipment for $21,000. And on the credit side, we have accumulated depreciation of equipment for $1,500, account payable for $3,000, and owner's capital for $27,000. And let's get into the transaction occurred during December 2017 of Analyzed Company. On December 3rd, Analyzed Company purchased 4,000 units of inventory on account at a cost of $0.74 per unit. And let's see the journal entries for this transaction. To journalize the purchase, wait, before we get into the journal entries, I need to make sure that we know this transaction will use the perpetual inventory method. So let's get into the journal entries of 3rd December in Analyzed Company. To journalize the purchases, we debit the inventory account with a corresponding credit to account payable with the amount of $2,960. Why? Because we need to multiply 4,000 units with the cost per unit of this inventory, which is $0.75. And we get this amount of money and debit and credit side. So the next transaction is occur on December 5th. On December 5th, Analyzed Company sold 4,400 units of inventory on account for $0.90 per unit. It sold 3,000 of the 0.60 cent of the 60 cent dollars units and 1,400 of the $0.75. Okay, on this transaction, we will write it on journal entries on the date 5 December. The sales of goods will require us to prepare 2 sets of journal entries. The first journal entry is related to sales. The debit is account receivable with corresponding credit to sales, which is account receivable and sales revenue. And we will write it with debit $3,960 on debit and credit side. The next entries we will write is cost of goods sold and inventory. Cost of goods sold and debit for this amount, $2,836, and inventory on credit for $2,836. So the next transaction is on December 7th. Granted the December 5 customer $180 credit for 200 units of inventory return, costing $120. These units were returned to inventory. The sales returns require us to prepare 2 sets of journal entries. The first journal entry is related to sales returns. The debit is sales returns and allowance with the corresponding credit to accounts receivable. So here are sales returns and allowance and account receivable. And we write $1,180 on debit and credit side. So the second set of journal entry is related to the cost of goods sold. The return are recorded by debiting the inventory account with a corresponding credit to the cost of goods sold, with the amount of money $120. The next transaction is occurred on December 17. On December 17, an analyst company purchased 2,200 units of inventory for cash at 80 cents each. To journalize the purchases, we debit the inventory account with a corresponding credit to cash. Here, inventory on debit for $1,760 and cash on credit for $1,760. We get this amount of money because we multiply 2,200 units with 80 cents. And we get this money. The next transaction is on 22 December. Sold 2,100 units of inventory on account for 95 cents per unit. It sold 2,100 the 74 cents units. The sales of goods will require us to prepare the set of journal entries. The first journal entry is related to sales. The debit is account receivable with the corresponding credit to sales revenue. With account receivable and debit with $1,995, and the same with sales revenue, but in credit. The second set of the journal entry is related to the cost of goods sold. The cost of goods sold is recorded by debiting the cost of goods sold with the corresponding credit to the inventory account. So cost of goods sold and inventory for $1,554 on debit and credit. Move to the adjustment data. The first adjustment data is accrued salaries payable for $400. As we accrue salaries and wages, we debit the expense account with the corresponding credit to the payable account. So here we write it as salaries and wages expense on debit for $400 and salaries and wages payable on credit with $400. The second adjustment data is depreciation, $200 per month of equipment. The depreciation expense is recorded by debiting the expense account with a corresponding credit to accumulated expense. So depreciation expense on debit and accumulated expense on credit with the same amount of money of $200. Okay, I think that's all for journal entries, and we will move to the point B. Enter the December 1 balances in the ledger T account and post the December transaction. In addition to the accounts mentioned above, use the following additional accounts. So we will move to the T account of this transaction of analyzed company. So here are the T account. This T account, we write all of the transactions that already occurred before. For the first account is cash, and at the end of the period, we get the balance of $3,040 on debit side for cash account, and the next one is account receivable. At the end of the period, we get the balance of account receivable for $9,675. The next one in the inventory, we write it all the purchase on debit and all of the sales on credit side. And at the end of the period, we get the balance of inventory for $2,250. Okay, the next one is equipment. We get the balance on debit side for $21,000. And the next one is accumulated purchase and equipment. On credit side, we get the balance of it for $1,700. Accounts payable on credit side also, we get it for $5,960. And owner capital, and at the end of the period, we get a balance on credit side for $27,000. Because of the transaction on December, we don't get any impact for owner's capital, so it stays the same with the accounts balance on December 1st, 2017 of analyzed company. And the next one is cost of goods sold. We get a balance on debit side for $4,270. Sales revenue on credit side for $5,955. And sales return and allowance, we get a balance on debit side for $180. And next one is the purchase and expense. On the purchase and expense, we get the balance on debit side for $200. Salaries and wages payable on credit side, the balance of it is $400. And the last one is salaries and wages expense. On half the balance on debit side for $400. Okay, I think that's all from me. And the next point will explain by Raja. Tujana, time's yours.
Okay, thank you, Moza, for the time. So I will explain the point C and D. So the first is C, prepare and adjusted trial balance as of December 31, 2017. So we already got here the analyzed company trial balance after adjustment. So the first is cash on debit, 3,040. The second one, account receivable, 9 on debit, 9,675. Inventory, 2,250. Equipment, 2,000 to 21,000. Accumulate depreciation equipment on credit, 1,700. Account payable on credit, 5,960. Salaries and wages payable, 4,000. Owner's capital on credit, 27,000. Sales revenue, 5,955 on credit. Sales return and allowance, 180. Salaries and wages expense, 4,000. Depreciation expense, 2,000. And the last one is cost of goods sold, 4,270. And we got the balance are 41,015 dollar. And the point D is prepare an income statement for December 2017 and classified balance sheets at December 31, 2017. So we got here on the analyzed company. On the first is income statements. Sales revenue, we minus it on sales return and allowance, and we get the total sales are 5,665. And for the cost of goods sold, we got on the cost of goods sold, the total of is 4,270. Then we minus it and we got the gross income 1,505. And then we put it on the operating expense. First, the expense are salaries and wages. The balance are 400, and depreciation expense is 200. Then we plus it and we get 600. Then we manage it with gross income. We get the net income. The balance are 905. So the income before tax is 905. And for the statement of equity change, we got here the owner capital is 27,000 and the net income is 905. So we plus it and we get 27,905. So for the last one is balance sheet. We first with the Activa, we got here the cash and accounts receivable, inventory, equipment, accumulated depreciation equipment, salaries and wage expense, depreciation expense, total expense, and cost of goods sold. First, this is cash. Cash already here, we put it 3,040, and the accounts receivable 9,675. The inventory is 2,250, and the equipment we minus it with accumulated depreciation equipment, and we got his 19,300. Then salaries and wage expense 400, depreciation expense 200. We plus it, and the total expense is 600. And the cost of goods sold is 4,270. So we plus it all, then we got the total Activa are 39,135. And the passiva is owner's capital, account payable, sales revenue, and salaries and wage payable. The balance are 27,000. The account payable are 5,960, and the sales revenue is 5,775. And the last one is salaries and wage payable. The balance are 400. Then we plus it all, and we get the same as Activa, 39,135. And we got balance in the Activa and Passiva. Thank you for the time.
Thank you, Raza. Okay, thank you, Raja. And for the E and F point, we'll explain it by Amila Sholehah. To Amila, that's yours.
Thank you for the time. So let me write the introduction. Compute ending inventory and the cost of goods sold under FIFO, assuming the analyst company use the periodic inventory system. So the FIFO is first in and first out. The sum method assume the goods are the first time above it was an item first sold. So for search the ending inventory, we search the cost of goods available for sale. In 1 December beginning inventory, we have 3,000 units and cost per unit is 0.6. So the total cost is $1,800. And in 3 December, company purchased 4,000 units with cost per unit 0.74. and we total cost is $2,960, and in 70 December, company make purchase is 2,200 and cost per unit is 0.8, so the total cost is $1,760. So the total of goods available for sale we get is 9,200 and the total cost is $6,520. So we search the goods sold per unit in December 5, 4,400, and in December 7, the sales return is minus 200. In December 22, sales is 2,100, and we get the total goods sold is 6,300. So the ending inventory is the cost of goods available for sale minus goods sold. So 9,200 minus 6,300, we get the 2,900 units. That is the ending inventory from FIFO method. So we search the cost of goods sold, we search the ending inventory. In beginning is unit 0, so the total cost is 0, and 3 December unit 700 and the total cost is 0.74 and the total cost is 580, and in December 70 2,200 and the cost per unit is 0.8, so total cost is $1,760. So the ending inventory is 2,900 and 2,278. So the cost of goods sold is cost of goods sold available for sale 6,520 less ending inventory 2,278. So we get the cost of goods sold is $4,242. That's the FIFO. The second is LIFO. The instruction is compute ending inventory and cost of goods sold under LIFO, assuming analyst company use the periodic inventory system. First, we search the cost of goods available for sale. In 1 December, beginning inventory 3,000. Cost per unit is 0.6. The total cost is $1,800. And in 3 December, purchase 4,000, cost per unit 0.74, and the total cost is 2,960. And in 70 December, purchase is 2,200 and the cost per unit is 0.8 and the total cost is 1,760 and the total of goods available for sale is 9,200 and the total cost is 6,520. Goods for sale per unit is same from before December 5, 4,400, and substitute minus 200, and 22 December sales 2,100, and so total the goods sold is 6,300. So the ending inventory is 9,200 minus 6,300. So we get the 2,900 units. So the ending inventory in beginning 2,900, and the total cost is $1,040. And in 3 December and 70 December, the unit is half sell, so the total cost is 0. So we get the ending inventory is 2,900, and total cost is 1,740. And cost for goods sold we get is available for sale 9,520 less ending inventory $1,740, and the cost of goods sold is $4,780. That's all for me. Thanks.
Okay, thank you, Mila. And we already discussed all of the instruction for point A to point F, and I will summarize our today's discussion. And first one is this is the journal entries for analyzed company on December 2017 with the adjusting entries also. And the next one is the T account of all accounts that occur on analyzed company. Also, this is the trial balance after adjustment, and we get the debit and credit side for $41,050. And the next one is the income statement, balance sheets, statement of equity change, and income statement of analyzed company. And the last one is the ending inventory and cost of goods sold with the FIFO and LIFO method. For the FIFO, first in, first out method, the ending inventory is $2,278, and for the cost of goods sold is $4,242. And for the last in, first out method, the ending inventory is $1,750, and cost of goods sold for this amount for $1,790. I think that's all from us, and thank you for the attention. I will end it with Assalamualaikum warahmatullahi wabarakatuh.